Here are three reasons you'd want to listen to this episode. One, you work or want to work in the software space. You're going to learn in this episode what makes software businesses so valuable, how they price software, and the key metrics that you should be measuring to make sure that you're competitive with your peers. Two, you're curious what different career paths look like after the military. I know when I got out of the service, I stumbled around for several years, not really sure what direction I wanted to take. You're going to hear the key differences between working at public companies, venture-backed, and private equity-backed businesses from someone who's sat in executive seats at all three. A spoiler alert, our guest thinks that a private equity-backed company is the best place for military individuals. The third, you're going to hear from an acclaimed guest in the software space, Randy Wootton. Randy is currently the CEO of Maxio, the revenue recognition and reporting software company owned primarily by Battery Ventures, who has invested in some of the biggest names in software, including Affirm, Amplitude, Angie, Avalara, Coinbase, Coupa, and of recent IPO fame, ServiceTitan. I'm excited to have you. I'm going to be your host, Brock Briggs, and this is the Scuttlebutt podcast.
What's the Scuttlebutt?
So, what is a scuttlebutt? Anybody hear anything?
Scuttlebutt! The definition of that word is a rumor or gossip.
Randy, I appreciate you taking some time to chat with me today. I really am looking forward to our discussion about pricing. Why don't you take 2 or 3 minutes and give us a quick introduction about you, a little bit of your backstory, and how you ended up as the CEO of Maxio?
Thanks, Brock, and it's a pleasure to be here. Yeah, so when I think about my career, I'm an old dude. I'm 56. I break it into 3 categories. First category is the military, and for your listeners, they probably would appreciate this more than most listeners. I was in the Navy for 12 years, was a bombardier navigator, so I wasn't the pilot, but I sat next to the pilot and bitched. And then I went back to the Naval Academy and taught literature for a couple of years, which was a lot of fun. Thought I was going to be a teacher, and then that was my first introduction into supply and demand. Is there's lots of supply teachers and very little demand. So I went to business school, spent the next part of my career, I think it was 14 or 15 years, working my way up the corporate ladder, both at startups and then big companies like Microsoft and Salesforce, which was just great. Got to see some of the greatest companies in the world and how they were run and how leaders thought about leading, which was a continuation of the journey of leadership that I'd been on since being in the Navy. And then I was able to make the shift to the C-suite, started off as a CRO of a public company and then got a battlefield promotion to CEO. Be careful what you wish for. I always thought it'd be cool to be a CEO of a public company, but if you're trying to do a turnaround, a public company, really hard. So sold that company to private equity, took some time off, went into another company as CEO. This one was MarTech focused. It was called Percolate, backed by some top investors, which we can talk about as being just one of the critical things to have as a top shelf investor syndicate. I had Sequoia, GGV, Lightspeed, first round capital, and spent a couple of years there, sold that to a company, and I continued on, which was an interesting transition from CEO to chief strategy officer, where I did M&A, deployed about $300 million in capital to buy some companies, and it was just fun not to be CEO for a while and to watch a great CEO, Doug Winter, do it and to learn a lot, having done it twice and then be able to sit on the sort of have the first seat watching it play out. Really helped as I went to my third company, CEO gig, which is where I am now, Maxio, which is PE backed. So I've done a public company, I've done a private company, VC, and I've done a private company now, PE, which is very different. We can talk about how those different investors think about assets and growth and et cetera. Yeah, so I've been here for 2 years. It's been a cool opportunity. Maxio is the mashup of 2 companies, SaaS Optics and Chargify. We focus on B2B SaaS specifically. We do billing, invoicing, RevRec, and reporting. And it was neat to bring 2 companies about the same size together. They did that in 2021. The CEO cycled out. I started in 2022, and we've been on that journey since then. Integrate the product, integrate the service, integrate the brand, integrate the go-to-market, and it's working. We could always have more growth. So, in any of your listeners or B2B SaaS companies who are looking for a billing, invoicing, or RevRec solution, give me a shout. I'd be happy to chat.
That's quite a history there. And we're actually Maxio customers. I talked with my CFO before this, and he said to give you the hat tip.
Awesome. Great. I love that.
Spread the
Thank
message. I didn't actually have to tell you that to get you on the podcast. So
yes, no, that's great.
So we're going to talk a little bit about pricing today.
Yeah.
Obviously, you've got everything that you just dictated there. A lot of the positions that you've held have been at subscription-based companies who
Yes.
operate off of like an annual recurring revenue basis. Why don't we start with just like establishing what ARR is and like why that's important? Why is that the sexy thing that every business wants to have?
Great, Brock. Broadly, people conflate two ideas: the way software is delivered and the way software is monetized. So when people talk about SaaS, software as a subscription, that is meaning that they're what we all think about. Like you go into Salesforce and it's a multi-tenant environment and you're getting access rather than an on-prem solution, which is what like the old Oracles used to be. So software as a service delivery. Then you can also think of how is it monetized. Monetizing meaning, do you pay for it on an annual basis? And as for via a contract, your billing may be different. But if you have an annual recurring revenue business, that's what we're talking about, AR, annual recurring revenue. ARR is different than revenue, and we'll talk a little bit about that. It's mostly tied to people's accessing of software. So how that would be different is when you do an implementation of software, you have implementation services. Those are statement of work, and they are not annually recurring because it's not happening every year. The challenge with the SaaS business model is you spend a lot of money on go-to-market to get a customer. And so the key is keeping the customer over time. And so the annual recurring revenue, you probably lose money in the first year. They talk about that in the CAC payback period. How long does it take you to return your customer acquisition costs? And if you can do it in a year, you're best in class. If it's taking you 18 or 24 months to return your cost of acquisition, that means the customer has to stay there for 24 months before you start making money. So that whole dynamic of you sign someone and you hope you grow forever. And that's where software companies like Salesforce and others have just been tremendous leaders in the marketplace, is because they have this ongoing flywheel effect of customers staying with them and growing over time. Versus the other model is, remember, like you'd buy a disk and plug it in your computer, like you were buying software, but you only bought it at one time. It wasn't recurring revenue. So all these companies are moving from big software companies are moving from on-prem, where you pay for the software, versus this web-based deployment and you pay over time. So that brings to light, Brock, a couple of things we can talk about is, how do you drive ARR? One of the biggest challenges with ARR and what Maxio solves is the idea of how do you recognize revenue? So you take ARR, you translate into revenue. That gets complicated in how you do it. And if you mess it up, you screw up everything, and you really put your chances of getting invested by a VC or doing a transaction, getting bought by someone, at risk if you don't have your ARR locked down.
Mm-hmm. You were saying that a lot of the major SaaS players are moving towards that, like they want to keep people for a really long time. The other lever or component of that, as you touched on, is the cost of the go-to-market. Is there focus on driving that cost down, or what are obviously you want to make a good product that people use forever. Theoretically, that at some point you're going to lose them. And so what are the different methods that you think about in terms of driving down the go-to-market cost to acquire customers?
Great. Because I'm a metrics guy, let me start with the metric. The first metric we were talking about is the CAC, customer acquisition cost. And so to capture that, you have to have a detailed P&L and where you're capturing all your sales and marketing expenses, and you're able to allocate them to different revenue streams. So let's say you have all your costs grouped. The other challenge then is to start thinking about what's the return on those costs. And I was talking a little bit about CAC payback period. The other one you hear a lot of people talk about is CAC ratio, which is what is your sales and marketing expense against the new dollar of ARR that you've produced. And people will split that into the sales and marketing expense you're using to acquire new customers. So that's new CAC ratio, versus expansion CAC, which is the sales and marketing expense that you're spending to expand customers, so get them to buy more stuff, more seats, more features, whatever. So if you think about those two costs, you understand what those are. There are benchmarks out there. There's a great guy, Ray Reich at Benchmark, who runs reports through surveys. So he takes survey, I think he has about an N of 2,000, and then he splits it and produces a report that helps you understand what best in class is based on your size of company and your ACV, the average contract value that you're selling. So you can get a sense for where you sit versus the other on the 25%, 50, 75%. And I think that's really important for companies and CEOs who are working with investors, because investors are pattern matching. They're pattern matching across all the different companies they see who are coming in and trying to get invested, and they have a portfolio. So Battery, who owns us, has a portfolio of 140 companies. Trust me, They tell me every single quarter where I sit compared to the rest of their 140 companies. And right now, I'm not top of class, which drives me nuts. When you have external reports, Insight Partners produces, OpenView produces another one, but Benchmark is where I would start. That can give you a real clear sense of where you are. For example, a CAC ratio of 1.2, meaning you're spending $1.20 for every dollar of ARR, is considered okay. But when I sit in a board meeting and I talk about my CAC ratio, the board is 100% focused on how am I driving those costs down through scale, efficiency, effectiveness. One way companies are doing that, and if you want to go down this path, we certainly can, is introducing what's called a product-led growth model versus a sales-led growth model. A sales-led growth model is what it sounds like. It's you have salespeople who are doing the sales motion. Salespeople are expensive. You got to pay commission. And that can be 20 to 30% of every deal. So 30 cents of every dollar you're taking for the first year is going to an AE commission. Whereas product-led growth, the product, people sign up, they self-instantiate, they get up and running, they put the credit card in, and it's super low customer acquisition costs. So there's a way to reduce CAC by scale. There's a way to reduce CAC by product offering.
Mm-hmm. The product-led growth thing is also another avenue that's super sexy, and everybody likes the idea of just buying more software and you don't need to continuously sell them. Yeah. I have a feeling that what the end state, or at least the direction that SaaS is going, is that it's probably not all sales-led or all product-led, but probably a combination of two. So do you think about the initial sales-led motion to acquire new customers, but leaning more towards product-led for the expansion revenue?
That's an interesting distinction, Brock. I think you're right, but let me go at it from a slightly different angle. What you often find today with SaaS companies is they're founded by technical founders. They think the product should sell itself. And with the capabilities that you have in terms of billing portals and payments, so Maxio has the billing capability there, you can get up and running pretty easily to get customers paying you. And so that's a product-led. Now, the key with the product-led motion is that it's not just a pricing model or go-to-market model. It's an entire company focus. So your product has to be, you have to be able to get up and running live in 5, I describe it. Like in 5 minutes, someone has to be able to click, get up and go. They have to be able to pay easily and self-instantiate. Their help documents have to be available. So it's an entire modality of thinking around self-serve. And I think a lot of companies start with that as their primary vehicle. Now, if companies are starting in the enterprise space, and that's actually very hard because enterprise sales motions are usually 12 to 18 months. It requires a selling committee, matching up with a buying committee, long buying process, so huge investment. But the contracts are often much higher in terms of ACV, so called $1 million. What you will find is those companies are designed very differently out of the gate. What I think, to your point, most companies are doing is starting PLG. They get a bunch of customers, low ticket value. They start to understand the product market fit. They get customers up. They see where the churn is happening. They start to focus on gross retention, so they keep the customers. And then they start to move up the segments, so from the S of SMB to mid-market. And it's now people on the other side are like, I want someone else to do the implementation, or I want some other features. And so then you actually need an AE to come in and run a sales motion. Right? Work through a statement of work, work through proof of concept, ROI. It's a more complicated sales motion. So they introduce sales-led growth when they get bigger and start to go after mid-market and enterprise. So at Maxio, we talk about it's not PLG or SLG, it's both. The future is hybrid. With regards to your point, which I think is interesting, would you use PLG for expansion? Again, I think it depends on the size of the customer and what you can afford. For the smallest customers, you want them to go to your marketplace and sign up for the next module and click it, and their credit card gets charged and they keep going. But that's a very different model than, for example, we have 2 basic offerings. We have the billing and invoicing, and then we have the revenue recognition and reporting. For you to get the revenue recognition and reporting, it's an implementation. And so that requires a customer success team. And so customer success team, your higher price customers, understanding what's happening, what's working, and how do you sell in more modules. So I think, again, you need both to grow like crazy on the new side, and you need both on the expansion side.
When you think about PLG and starting from the bottom up, there are obviously some key things that you really need to drill into. You mentioned retention. I'm guessing there's companies need to come up with some sort of activation metric or time to value. What are the, maybe if you could talk about that and or anything else that people working their way up that spectrum ought to be thinking about to make sure that they've got product market fit and ready for an enterprise level offering?
Great question. Another friend and colleague who's doing great stuff and highly recommend is Ben Murray, and he's the CFO guy. He offers a course for finance people, executives on SaaS and operating metrics, and he has a dashboard. Reminds me back when I was flying in A6s. You have your radar. I call it a business radar, and there are 27 metrics that you could be tracking. And the way he structures it is there's a set of metrics, I don't know, 4 or 5 that are on the left-hand side of his matrix, which are the ones you want to focus on when you're coming out of the gate. And then as you get more mature, you layer in these other metrics. And so when you're most mature, you're talking things about like operating leverage. But what I would say is just at the high level, when you're just out of the gate and looking for product market fit, what you're trying to determine is 2 things: replicable sales model. So call it more than 10 sales. That it's not your friends and your cousins who are buying your product, but you've actually had to go out and sell it to someone and convince them of the value, and they're willing to pay for it. Once you move past 10 sales is when you could probably start to look for, if you're a technical founder and you don't like selling, is try to find a VP of sales to come in. And that VP of sales is then going to be responsible for building a pipeline, building a forecast. And they should be able to talk about how they build that pipeline, how they build the forecast in terms of commit, most likely, and et cetera, and what that looks like. And so you start looking at win rates. You start looking at days to close. There's this metric called sales velocity, which aggregates all of that up. And again, I highly recommend people, if you're a technical founder or coming out of the military, is go look at sales velocity. It is the best single metric I've found in terms of understanding what's happening on your sales motion. After you get, 20, 30 customers, and you've been going on around for a year, now you're going to have to start focusing on gross retention. Back to our conversation around ARR and the importance of maintaining customers and customer lifetime value. That is where it becomes critical. And the key metric is gross retention, is of the ARR that you started with. So you started the year with the ARR and logos. You started the year with $100,000 in ARR and 100 logos. At the end of the year, how much of that did you end up with? How many customers stayed with you? So theoretical maximum is 100%. Actual formulaic maximum is 100%, right? Like you can't have more. But anything north of 90% is considered pretty good. If you're down at 70% in gross retention in that first year, you got a problem. You need to look at why those customers are churning. Was it an oversell? Was it a hard implementation? Was it their needs changed over time? And you got to secure that gross retention. The metric after that, which is the one that a lot of people tune into, is the net recurring revenue and net revenue retention, NRR. And that's basically talking about, are customers buying more? Are they buying more seats? Are they buying more features? Are you crossing divisions? Because that's the secure and expand motion, land and expand. And so I think those 3 metrics, like bookings growth, sales velocity, to help you understand if you're out of the gate, got product market fit, gross retention helps you understand if you've got a good business model, and net NRR is helping you understand if you're going to have the future growth driven from your core base that helps you be one of those rock star companies.
Can you talk about the relationship between pricing and retention? Maybe early on, I think it's easy to, if you're maybe still in the product market fit category, your first instinct to retain a customer might be to discount the price, but I'm guessing that's probably not a sustainable option. But maybe talk about that relationship and then maybe how that flows through once you've got that product market fit established, and making sure that, and maybe we can talk a little bit about articulating the value prop and how that kind of flows into pricing as well.
Happy to. And just another friend, I just, all these people that I've been interviewing on my podcast and learning a lot about, is a guy named Dan Bukowski. He's forgotten more about pricing than I'll ever know. So if you have any questions, go check him out. He's got a great blog. He's got great recommendations. I had him on my podcast, and we had a really great conversation, which I'll summarize some of the insights, but they're not original. The thing that we've talked about at Maxio is to drive ARR, you have new logo growth, which we talked a little bit about. You have gross retention and net retention, which we talked about in your current customer base. And you have this other element, which I don't think I fully appreciated until I came to Maxio, which is monetization. And monetization is more than just price. It's price, it's packaging, it's how do you make money from your customers and new customers and segments. And we'll talk a little bit about it. And so we talk about the monetization strategy. What's the offer you're putting into the market? How are you getting customers up and running on your system? How are you using the analytics? So Maxio provides customer cohort analysis so you can look at what's happening in terms of gross retention, net retention, LTV to CAC, magic number, all of these crazy operating metrics. But you can look at it by customer, by product, by region, by segment to help you understand what's working, what's not. And then you can roll out new pricing. So just very specifically at Maxio, our price is based on effectively our customers' revenue. So it's not a seat-based model. We charge a percent of revenue, which was new and different for me. And you have tier-based pricing. And so if you go up the tier, you get a different price. And think of it as like like a data plan AT&T. Like the more you consume usage-based, the more you pay, but you have different rates. I don't think I didn't fully appreciate the lever of pricing before coming here. And pricing was always like a dark art that people did. And oh my God, how do you do it? And so we have been, I would say Dan says this, but the number one play, one of the major tools in private equity playbook is pricing. It's one of the first things they do. And why is that? Because it's the untapped lever of growth that everyone's afraid to touch. And so that's been my learning over the past 2 years, is to really dig deep into pricing, understand what's happening. We talk about some of the best practices and have a ongoing, consistent way of reviewing pricing. So we have a pricing council that meets monthly. We roll out pricing for new customers and current customers. We're trying to figure out what's working, what's not. But it is a huge lever that I think a lot of people underappreciate.
I'm not sure if you were at Maxio at the time that they switched to a revenue focus. Have they always were tied to how much revenue you're making? And maybe talk about that observation as why is that the metric for customers in terms of the value prop?
Yeah, so I think I've only been here for 2 years, so I don't know what the original pricing was. I would say that this is pretty standard in the marketplace. So Stripe, for example, charges, I think it's 0.07%. And now they just increased that from 0.05 to 0.07. Zora, all the other companies are in this model of some percent of revenue. And the idea is, why does it add value? Is, well, as you increase in size, the level of complexity you're billing and invoicing, and then the amount of data that you're producing. So the processing and the insights you get in terms of RevRec and reporting becomes more valuable. So you could say in some ways, when you're an early stage company, we underprice, because we're giving you an enormous value of the platform that you're probably not taking full advantage of at a very low price. But as you grow, we grow. So your success, we're invested in your success, and we benefit as you continue to grow. And so I think it's the industry standard in this type of business model, and it is aligned with value. Having said that, there are people out there who are like, gosh, why am I paying you on percent of revenue? I only want to pay on like number of invoices. We aren't a utility. Like, we're not ensuring the water is going and your invoices are going out. And so I do think for some CFOs, that's a little bit of a mind bender, but it's industry standard. So what you pay, a little bit of negotiation, how you pay, do you pay up front, do you pay monthly, totally open to negotiation. But the idea of having an annual contract, so that's annual recurring revenue, and that it's tied to your trailing 12 months billing, invoicing, or whatever, is pretty consistent. And it does feel like we have 50 public companies that are using us, not for the whole company, but for divisions where they're using usage-based pricing. I have a couple of 100 companies that are better than $100 million. And the type of insights you get, honestly, Brock, part of the reason I came to this company was I was CEO of Percolate, and my CFO brought the legacy SaaS optics, which is the RevRec and reporting tool, to bear. And I was resistant. I was like, what we don't need is another internal software. And the CFO overruled me and brought it in, and it changed our lives. We went from the first 6 to 8 days of every business month, the CFO and his or her team having to close the books, to then you spend the next 8 to 10 days trying to figure out what just happened using Excel. And if you got a lot of customers, a lot of products, a lot of pricing, it's really difficult. Someone fat fingers the Excel file, everything screws up, and you go into the board meeting and your numbers, you're like, I don't know, I think they're right. 2, the difference is on day 1, being able to push a button and know exactly what your ARR is, being able to split it out, as I mentioned, by segment, by region, by product, start to really explore if churn's happening or net retention's not where it needs to be. Like, my ability to run the business is radically different with a solution like Maxio. It's like having a business radar. I'm able to see the mountains before we smash into them. And the other piece I would say is it gives you great insight into revenue leakage. So there's an expert out there who talks about 7 to 9% of all revenue is lost because of billing and invoicing. You didn't invoice correctly, you didn't collect, or a customer refutes because you don't have appropriate documentation. So think about that. You spend all this money to get a customer up and running. You spend all this money to support them. You spend all this money to deploy your software and have it working on behalf of the customer. And when it comes down to getting paid, your invoicing process reduces your revenue by 7 to 9%. So I think the value is both in the visibility, the insights, and the revenue management.
You were mentioning earlier that you guys break up customers into different segments and want to talk a little bit about like some pricing best practices. Maybe you can pull in the pricing council that you were talking about. I'm sure these are the things that they are discussing about where these lines are of how do you determine how much revenue, what is the cutoff for like maybe a really small business and make it attractive enough to where that they want to stay and keep going and growing with you.
Yeah. So the first one of the best practices of pricing, you just nailed it, is segment your market by the value your product provides. So you want to focus on the different outcomes that different customer segments are trying to achieve. And this can give you the best chance to create packaging that reduces your CAC and decreases your sales cycle and ultimately allows you to dominate your market. So let me give you a very specific example. We would say our ICP, like we can sell to B2B SaaS companies, broadly subscription-based companies. Our bullseye, so where we have the most value is B2B SaaS, and we have two personas that we focus on. One is the early stage founder, so they're just getting up and running in their garage, there may be pre-revenue, and they need a billing solution. They don't really care about RevRec and reporting at that point. So the package we put together has to be low price, it has to be able to get them up and running, super easy to instantiate, and so like the billing portal is really important, some other things, dunning, all these nerdy topics. The next inflection point for us is really when a company is about 30 employees. And so they've moved from having Uncle Bob do the books as the bookkeeper to hiring a fractional CFO or maybe a professional CPA firm to bringing someone on full time. That person now, you probably at this stage might be looking for professional money. So you're moving from cash accounting to accrual accounting. Things are getting really wacky with ARR, RevRec. You got investors who are wicked smart on Excel files that are beating you up because your metrics aren't working. That's our RevRec reporting solution. So that's a different package that we position. It's all one platform, but the way we think about the pricing and the packaging is just very different by segment. So that's an example. And I do think our billing customers tend to start with us when they're smaller and grow over time. And the RevRec is medium and then they go bigger. We have introduced, we went through this exercise. We have 8 different cohorts of customers that we're now looking at and thinking about what are the pricing plays that we should be doing. So that is a lot of complexity, and that comes down to we have large customers who have customer success managers on them who could be taking advantage of many multiple modules that we have. And so what's the packages we put together to have them take advantage of expenses or project-based pricing or advanced revenue, like all of these different capabilities on top of the platform, which is very different than if you don't have anyone. We have 2,000, 2,400 customers. A lot of the customers, we don't have a CSM on them. So then you have to think about how do you do that outreach to that segment and try to get them the upsell or to ensure that they're going to renew. So again, the pricing, packaging, monetization strategy roots in your segments. I think the other best practice is really getting aligned with what are you trying to do? Are you trying to drive your business objectives? You're trying to increase revenue and trying to increase profitability. Now, if you, like me, have worked for VC and PE for many years, you know that when you go to the investors, they say, do both. Increase revenue, reduce costs. And you're like, yeah, thanks. That's not that helpful. But I do think you need to be clear about what you're trying to do, and your pricing strategy needs to align with that. And so it's like business strategy informs product strategy. It informs your pricing and packaging strategy. And that will allow you, like one of the things we're working at Maxio right now is unit cost economics. How much is it costing us on a per customer basis to sell and service and grow? And that's really different by segment based on the resources that are being deployed. It's actually a really hard exercise. And so for any of your listeners out there that are early in their career and their company, I would say if they could focus on unit cost economics early so that they're documenting it, then they're able to see how much money am I making on this type of customer, where am I winning, and how do I get more of them? And they'll also see where are they losing money and how do they move out of that segment. So when I was at Percolate, the remit was to take the company from a mid-market social media platform and transition it, pivot it to an enterprise content marketing platform. And we had a lot of churn in that mid-market social media space. And I actually had to isolate those two segments and talk to the board about saying, look, this segment is declining in part because we're not investing in it. We're not investing in the product there. We're not investing service people there. So I expect that churn to be high. This segment, which is the new segment, I expect us to have great logo growth. I expect us to have much better gross retention. You're going to see all of this. And so that segmentation exercise, alignment around what you're trying to achieve by segment in terms of growth or retention or end-of-lifing is wicked important.
When you think about introducing, as you're trying to figure out these different points of where you're like you were saying, hey, we've got a bunch of revenue here. How do we get more of that? And where you're starting to lose revenue or maybe get churn at a specific price point. Are those the places where you should think about implementing some kind of pricing strategy change? Assuming maybe somebody is just starting out with and has done no segmenting or anything like that. They've got maybe flat pricing or the classic, the 3 tiers that are maybe just random prices that they came up with. Where are those milestones where they should look to implement those? And how do you even start to guess at where they should be? Do you just start with a small cohort of customers and see if they leave?
It's a great question. I've never been a founder. I'm not that smart. So I will give you some observations. I think that there's rarely a radically new product out there that no one has ever bought something like it before. So there are data points in the marketplace in terms of what the market rate is. So doing some research in the category, you say, hey, this is the category I'm going to be going after. What's the current market price? I was just talking to a friend of mine who's, for example, I do think AI is revolutionizing this and is going to have radical impacts on how people price. But let me give you an example. So we were talking about a new AI tool that he was going to launch. It wraps around ChatGPT. It provides insight and advice. I can't go into much more detail. And we were talking about pricing. And I was like, in the market right now, if you buy ChatGPT, it's about $49 a month. So that's probably the minimum that you could charge, right? Because people are going to, that's okay. And then what's your upper bound? There's an idea of the value thermometer in terms of how much value you're creating versus how much you're extracting from your perspective. And then if you look at that and think about from the customer's perspective, how much value are they perceiving they're getting and what are they paying for? And there's some rate in between that where you're maximizing your value and they feel like they're getting value. So the upper limit is the other thing you need to look at. And I was like, if I were to ask someone for advice, I would expect to pay $500 an hour. So if the value that you're providing, like when I do these GLG things or I get called in for consulting on due diligence, my rate's $500. I probably should charge more, but call it $500 an hour. There's some range between 50 and 500. Now, if you are just getting started, you probably need a price penetration strategy, a market penetration strategy, which means you're lower cost than the alternative. So if there are other people out there offering it at $200, maybe you come in at $100 and you start. And I think one of the things, it's less about the amount, it's who and how you charge that determines what you can charge. So understanding your ICP and the persona that you're going after. So for us, if we're going after the technology founder, we're charging for a billing solution and we're $7,000 a year minimum. Like, how do they think about that? How do they think about that compared to all the other technologies that they're buying? They're probably not going to be willing to buy $20,000, but if we sell for less than what our competitors are offering, then we're doing a price penetration strategy. So I think it's some netting it out. It's doing the market research. It's understanding what your minimum could be based on your costs, like we talked before, right? The customer acquisition cost, deciding if you're going to be negative for some period of time because you're trying to acquire customers, so that you'll cover your costs through that model we talked about over time. It is understanding, talking with customers. Hey, help me understand. How do you think about the value? Everything in terms of value versus the actual number. Would this be value? So doing some research on that front. And then the other thing is, if you are working with professional investors, your seed, Series A, is talk to them and see if they've got a consultant who can come in and do as an advisor for in the space if you've literally never done it before. Because you can always change pricing, especially with websites. You just change the price on the website, but do lots of pricing experimentation. Launch something this month, see how it works in terms of attach rate and then churn rates, and then launch something next month, and you'll start to dial it in into where that value exchange is appropriate.
You mentioned having conversations with customers. I know that's a scary thing to some people, but early days, it's certainly very important and important ongoing to make sure that they're realizing the value. I think most people always think that they're paying too much for software, but trying to communicate the value that you're bringing to them is probably a critical piece of that, especially in the upper end. How are you guys at Maxio with, I'm assuming you've got all of this data about all of the business's revenue that's flowing through. You're probably very easily able to show, look at what we're doing for you guys. And is that kind of a tactic or a strategy that you think about people should consider when they're like, hey, what is it that what service are you offering, and how can you get to be a critical part of their workflow and say, you can't survive without us?
Yeah. I think what I joke about, pricing is the conversation. So I'm a parent. I've got 2 kids. Yeah, we're talking about sex and drugs. It's not the conversation you want to have, but you're going to have it at some point. You get to choose. Do you have it before they do it, or are you talking to them afterwards when they're in trouble? And I think with pricing, similarly, you're going to have the conversation with the customers. It will happen at the beginning of the cycle, and it'll happen at time of renewal. And if you haven't modified that or driven your approach to have this ongoing conversation around value, what you're proposing, and then value realization, you're going to end up in a tough negotiation. I think most people in B2B SaaS, especially if you're selling other B2B SaaS people, realize that you got to charge something, right? And so then it's just, what's the value? The play that I've seen work, especially as you get into the enterprise space, is an ROI calculator, or you can hire people to do this for you. You don't have to, but you sit down and say, look, what are the dimensions along which, primarily with workflow application software, you're talking about efficiency and effectiveness. Like, I'm making you more efficient, or we're making you more effective. Help me dimensionalize that. So we sell to finance teams. One of the things we argue is that we help you have hire fewer people in finance, on billing in particular. So my CFO, who's had a lot of experience at PE companies, would say he would need a team of 11 to 12 finance people to run our size company with our complexity and number of customers, et cetera. But we have 7. So when you create an ROI calculator and you have case studies of people who said, hey, I was able to run this size organization with this many people, that becomes a real value trade-off, right? That savings is resultant because of this product. We should be able to capture some of the upside there. Effectiveness, to like revenue leakage. That's why we bang on the drum around revenue leakage. Do you know what your revenue leakage is? If you don't, put us in. We'll help you find out. We can help you on that. The other things that we emphasize is just that insight that you have with customers in terms of their billing and invoicing. A company I was talking to said that 10% of their issues, their customer escalation issues, are tied to billing and invoicing. So we make that easy for you. That's reduce your support costs. So I think that each CEO needs to think about value along those dimensions. If your workflow application is efficiency and effectiveness, where are you saving costs? Where are you making people smarter? And dimensionalize it. And the trick with this is you don't come to them and say, hey, I can save you 100%. You have a conversation with them, and you say, how many people do you have? And how do you think about the number of people you would hire in finance? And so they're giving you the input that you help build a model together. And so at the end of the day, you come back and say, okay, great. So we agree. The other way people talk about it is total cost of ownership scenario. So if you create a total cost of ownership for our product, it's this, but here's the return. And in the sales process, the people are going to be, yeah, I don't really believe you, but okay, I get why I can now make the business case to get this thing bought by my CEO or whoever. The key is taking that TCO or ROI analysis and handing it off to your customer success team. So the customer success team then is delivering on the value through the implementation and adoption process. And they talk about, hey, we were going to increase your efficiency, we're going to reduce your revenue leakage. Let's track that so that at time of renewal, if you're doing an up or if you're increasing price, which is what most SaaS companies have done recently, you can justify it by saying, look, we said we were going to deliver this, we've delivered this, and we think there's more to deliver. So it's an ongoing value conversation versus I paid $9.99 at Walmart for it.
Do those value conversations all end up boiling down to how you're either saving the customer money or making them more money? Is it really those two things, or is there other things there I'm not thinking
Yeah,
of?
I think that's right. I think more broadly, so Maxio, the thing when I was at Percolate that was the difference for me was things that were a little bit more abstract in terms of how do I run the company. So all those operating metrics in terms of understanding gross retention, net retention, which isn't, it's directly about making money, but it's different than, a little bit different. The other thing is, if you're going to go raise money, the number one deal killer in transactions are accounting errors, is people don't have the right ARR roll forward and they don't have the customer cohort analysis. And so, like, how do you put a value on that? Our best customers are repeat customers or multiple time CEOs who've had to raise money because they know when they go through that process, we have investor grade metrics. The investors say, oh, this is awesome. Every investor I talk to has Maxio in their portfolio. They love the Maxio companies. We're not the only ones that offer this, but here, let me give you an example. So I was chief strategy officer at Seismic. We did 3 transactions, 2 were acquisitions. One was 10 times, call it the Apple, was 10 times the size of the Orange. The Apple had SaaS optics in it, and it took 1/10 the time for us to do the due diligence and the forensic accounting to figure out what was going on with their ARR and to ensure that we understood, because you're buying revenue streams, right? You're buying customers, you're trying to understand the customer is going to stay. So that whole conversation we're having about gross retention is directly impacting the asset value when you go through a transaction. The other company, the Orange, was 1/10 the size, but they had contracts like in the filing cabinet. So we spent 10x, 10 times the amount of dollars for 1/10 the size company to go find and figure out what the ARR was and if we really believed it. And so that is a huge tax through the acquisition process that it's hard to dimensionalize, but it's something that any CEO who's gone through due diligence and has had the proctology exam and knows what it's like to sit for 10 hours walking through every single customer contract and being able to document. This is when we sold Rocket Fuel. I sat for, 8 hours. We went through every single customer contract. Well, what's going on? Why did they spike here? And the PE firms, Excel jockeys are in there banging their models and they're building certainty, et cetera. But that whole thing is made immensely easier by having a RevRec and reporting solution. So that's one of those more kind of abstract values that you're not going to get unless you really have done it before or have aspirations to do it.
We've talked a lot about measurement and metrics in this conversation, like a whole lot. Do you have any guidance or advice about how to draw proper comparisons to make sure that you're comparing apples to apples? How long of a period of time should we be looking back to make proper comparisons? They talk about in Working Backwards, the book on Amazon, trailing 12 months and forward 6 weeks, but there's not really a whole lot of great advice about, hey, these are the time frames you should be looking at.
Yeah, Amazon rocked it, and I have an enormous respect for how they run their business and think about many different ways of doing their business. So I'd say do what Amazon does. It seems like they've done okay. In general, what I found in the companies I've been CEO of and the boards that I've sat on is what, at the very least, you want to do the trailing 12 because that helps you understand year over year. So when you look at July of this year and our performance, we go back and look at last year across all metrics in terms of MQLs, SAOs, conversion rates, BDR, SAOs for BDR. So you have these set of metrics you're looking at by function and you look at the trailing 12. I think it's also important to look quarter over quarter because you want to see growth quarter over quarter. But within that, what's really important, again, on the seasonality, especially with SaaS metrics, is to look at first month versus first month. So January versus April. Because what you often happen, especially with bookings, is you'll have this kind of, we hate it, but you end up with most of your bookings happening in the third month of the quarter. So if you're comparing April to March in terms of bookings growth, April often is lower than March. You'll be, oh my God, everything sucks. Instead, though, look back at last year, April, and then look back at January, because that was the first month of the quarter. And then go look back at September, and you get, I think those are the key. So that's a 12-month look. When you're doing business planning, what I have seen is you actually go back by quarter. You go 8 quarters back. And the 8 quarters back gives you a 2-year look as you're trying to build out your 3-year model. So like we're going into, I always recommend people to with their board meetings is set up topics around the year. So your September board, assuming you're a calendar year, fiscal year, your September board meeting should be your strategy meeting, and then you come in November and you do the financial plan. Your February board meeting can be your people review, and then your June, July board meeting is like your product strategy. That way you have strategy informs what your plan is going to be, both the 3-year plan, the next year operating plan, and budget. That then tells you how many people you can hire and promote, et cetera. And then that also allows you to figure out your product investments. So you come in to this cycle, you have your strategy in September. Now you need to be building your financial plan. And to do that, you need to have your historical 2 years and your roll forward 3 years. No one's going to believe your 3-year plan. But what they do want to see, especially private investors, VC and PE firms, is that you have a growth agenda, which shows what it would take to realize a certain outcome, an enterprise value that's in line with their expectation in terms of return. So most VCs want a, 5 to 7x return on their money on money. PE firms, 3 to 5x. And then it comes down to over what period of time. So your 3-year forward plan gives you an opportunity to say, so we think this business can grow 20% per year, or 20% this year, 25% next year. We're going to layer in these acquisitions. Those are all going to grow this. And so then you have, so for me, I'm talking to the board about 2027. And here's what we think the shape of the business would be in 2027 and what we need to get there. So having the 2-year, 8-quarter look back allows you to stress test, are those trends, do you really believe those trends? If you've only been growing 5% per year over the last 2 years, and all of a sudden you show a plan that's going to get you to 20%, I don't know. So that's how do you think about what data you need, and that's why you need a really good CFO who's able to swing through all of that. I think there's some great technology out there, FP&A solutions, Mosaic, Giraffe, Basis, Forecaster, FinStrat, that can help you with this scenario planning. If you're not an Excel whiz, you can also, there are great companies out there. If people want recommendations, I'm happy to provide introductions to firms who do this as like fractional CFOs who can help you do this planning, because getting that business plan and the model is just wicked important for running the business, setting up the investments, and raising money. So that's a whole bucket unto itself. The other piece which you were asking about, I just want to underscore, is the benchmarks are the things you use, your historical benchmarks, but then the thing like Benchmark It, the report from RevRec, where we have a lot of information in terms of what is best in class for SaaS companies broadly. All the VCs and PE firms share their data, so you can see where you are, you can see what you need to be. And that's where I'm using things like, hey, north of 90% gross retention, you're going to do okay. North of 105% on net retention, great. North of 85% gross margin, awesome. Rule of 40, which is a combination of your ARR growth and your EBITDA percentage, spot on. So those 5 metrics, if that was 5, are like the key ones. And those are just high-level metrics that people would say are best in class. But you can have it parsed out more specifically by what stage you are, so size and revenue, and your ACV. So what type of business model? Are you high velocity transaction, or are you more of an enterprise sale?
Is there anything about pricing or any specific stories that we haven't touched on that you do?
Let's see. All the things I've gotten wrong. You want me to just lay that out?
Those are always fun.
Those are always fun. Yeah, really humbling. I'll tell you one story which was really interesting. So I was a public company CEO, a company called Rocket Fuel. And when you're public, all your information is public. We were a first-gen AI company, which is relevant because I think there's a lot of AI companies out here who are trying to figure out how to price. And we were basically we were a marketplace for media planning and buying. And the AI really worked. It wasn't BS. And it achieved much better results than if you just had a human doing the media planning and buying. And we were making like 60% margins. The agencies that we worked with were only making 10%. And so when they saw, and this is before I joined, when they saw our business model, they thought we were cheating. They thought something was wrong. This is like 2015. No one knew what AI was. And oh my God, it's the bots. They're all going to put us out of the business. And so I think the founders at the time wasn't being greedy, but it was the whole idea of value exchange, recognizing that your channel needs to make money. And so how do you help the channel make money while you make money, right? Greedy pigs get stuck. If you're making all the money, they're going to screw you. And that was where we really struggled. And then came a company that was agency first, so channel first, called The Trade Desk. And now they're one of the top companies, public companies out there. And I think a lot of it came down to their channel strategy, but it was pricing within the channel. How do you ensure your channel makes money? And so as companies think about moving from a direct sales model to a channel model, what I would say is go hire smart people who know how to run channels. And it's worth the investment because they'll know what the incentives are. They'll know how people make money. And you want to make sure that your product is, they want to represent it and sell it so that you're getting that pull through on the channel.
You've mentioned people a lot on this call, and
Yeah.
I couldn't agree more that finding really good people is super important if you want to do really big things. A lot of people cringe at the price that it takes to hire really good people, or those people aren't hireable. Do you think that's worth it? And how should founders or CEOs think about doubling down and being willing to pony up the cash to hire A players?
It is so hard, especially when you're at PE companies that are jamming you on cost per FTE. What I would say is you just got to be super clear about what you need at this stage and the next stage. So if you're a $10 million company, you don't want to hire someone who's only seen it, the movie from 0 to 5. You need that person that's seen it from 10 to 20. You don't need to hire the person who's been at 100 million. And they're different price points. I think this is one of the values of having a VC is they usually have an HR operating partner who has deep network across the portfolio and is always staying in touch with people that they've worked with in the past. So if you can call up and say, hey, I need a new head of customer success, you can do it through your network. So I hired a head of customer success and a head of marketing without having to use a recruiter. Sometimes you hit the wall and you can't find the talent that you need, but you know what you want. You've tapped your network. You got to hire the recruiter. And the recruiter is going to charge 30% at least of salary. And that's a big lift when you're hiring someone a couple $100,000. I think for roles like CFOs, or heads of technology, where you can find recruiters who that's all they focus on. If that's not your area of expertise, it's really useful using a recruiter. And we did use a recruiter for our head of engineering and our CFO, and it made a big difference because they're able to shortlist the candidates based on the job description you have. And I wouldn't know those people. So I think it's a little bit of this tap your network. I also talk to a mentor. If you're brand new, like if you're a brand new CEO out there and you're a veteran, reach out to me on LinkedIn or send me an email at randy.wootton@maxio.com. I'll be happy to talk about sales profiles and who you should be hiring as a VP of sales for your first gig. I can help you write the job description. I can help you think about candidates because you can really screw up hiring a salesperson. Salespeople are best at selling themselves, and they will wow tech founders with all their charisma. And you got to be able to see through that, back channel it, and find the person who really has done the hard work of early stage startup selling.
You've worked at a whole slew of different companies, public, private, VC, and PE backed. Any 2 cents of advice on how to find what is the best fit for you?
Well, very few people are public companies, right? So good luck. I think there's only 4,000 in the U.S. If you can do it, great. If you can run a company all the way there. So I say the distinction between VC and PE. VC is focused on growth and bets. The VCs are investing and buying a horse. Like who's the founder and do they have a really great idea? If you're that person that sees a problem in the marketplace and you have complete conviction and passion around it and you're willing to take a relatively low salary because you want the equity upside, VC is the model for you. This tends to be early stage, like 20-year-olds, or you're sleeping on your mom's couch, or you already hit it once and you got enough money that you can take you're doing the bet on the equity. PE, for military folks, I think actually PE is a pretty good way to go because it's around driving efficiency and scale. And so thinking about systems and how do you leverage through leadership and automation. And I just think a lot of military people I've talked to have that orientation. They're not as risky in terms of business and finance that a VC person might be. They're risky to go off to battle and all that. But it's a different orientation. And I think the military mindset works great within we're going to go optimize this business construct. And so PE focuses on EBITDA, driving multiples of EBITDA. VC focuses on next 12 valuation, multiples of your next 12 months of revenue. And so there is a very different orientation. And again, I'm happy to talk to people if they're interested in chatting more.
Randy, this has been a super fun conversation. I appreciate you breaking all this down and sharing your knowledge and wisdom with us. What could myself or anybody listening do to be useful to you?
Listen to the podcast and share it. We have a podcast called SaaS Expert Voices, and I think my mom listens to it. But we're trying to get the brand out there. And if you are a B2B SaaS company, CEO or CFO, or thinking about doing it, I would love to have a conversation about what are you thinking about for billing and invoicing and RevRec and reporting. And we have a bunch of early stage companies, and we could be a great partner for you.
Fantastic. Randy, I really appreciate your time. Thanks so much.
My pleasure.